Today we will be discussing commercial mortgage-backed securities. Now, let us quickly discuss the structure of commercial mortgage-backed securities. Now, what a bank or what a lender would do is that it would pool its commercial mortgage loans. What are commercial mortgage loans? Uh, Commercial mortgage loans are basically loans given to purchase office buildings, warehouses, shopping centers, hotels, healthcare facilities, etc. etc. Basically, loans given to purchase commercial property where the commercial property is pledged as a collateral to secure the loan. Right? So, the bank would pool its commercial loans and sell it to an SPV, and the SPV in turn would issue bonds that are backed by the pool of commercial mortgage loans. Now, once the bank sells these loans to the SPV, these loans belong to the SPV, and the borrowers of these commercial loans won't pay their EMIs to the bank. They would now pay their EMIs to the SPV, and the SPV would use these EMIs to pay coupon and principal to these bondholders. Now, these bonds are known as commercial mortgage-backed securities. Right? These bonds are known as commercial mortgage-backed securities. So, what is the idea here? The bank pools its commercial mortgage loans, sells it to an SPV. The SPV in turn issues bonds that are backed by this pool of commercial loans. The borrowers of these loans won't pay their EMIs to the bank anymore. They would pay their EMIs to the SPV. The SPV would use these EMIs to pay coupon and principal to these bondholders. These bonds are known as commercial mortgage-backed securities. Another idea here, guys, that if the borrower defaults in repaying these commercial loans, then the losses due to these defaults would be borne by the investors in these commercial mortgage-backed securities. Right? Now, another point here is that, guys, these commercial loans are non-recourse. Usually, these commercial loans are non-recourse, which basically means that if the borrower defaults, then the bank can only seize the commercial property which has been pledged as a collateral. So the bank can only seize the commercial property and sell it to recover the amount defaulted. However, if the commercial property is not sufficient to recover the amount defaulted, then the bank, that is the lender, cannot seize the other assets of the borrower to recover the shortfall. Right? So these loans are usually non-recourse. So since these loans are non-recourse, we do not evaluate the credit risk of the borrower who took the commercial loan. We evaluate the risk of the commercial property. We evaluate the credit risk of the commercial property. So for evaluating the credit risk of the commercial property, we usually study two ratios, which is the loan to value ratio and the debt service coverage ratio. Now, what is the loan to value ratio? It is calculated by dividing the loan amount by the appraised value of the commercial property. And the basic idea is that, a lower LTV ratio would mean lower risk to investors in commercial mortgage-backed securities. Why? Because if the LTV ratio is lower, that basically means that the appraised value of the property is significantly greater than the loaned amount, and the lender is more likely to recover the loaned amount in case the borrower defaults. So a lower LTV ratio implies lower risk, lower credit risk faced by the, basically implies that the CMBS holder is facing less credit risk. And then the other ratio is your DSC ratio. DSC ratio is calculated by dividing, the annual operating income of the commercial property by the annual interest and principal that needs to be repaid in a particular financial year, right? So basically the interest and principal that you would pay in a particular financial year to service the mortgage loan. Now, how do we calculate the annual operating income? We deduct depreciation and cash operating expenses